Divergence is the most over-trusted signal in technical analysis. Every textbook teaches that when price makes a higher high while RI makes a lower high, a reversal is coming. The reality, divergence persists much longer than most traders' stops can survive, and the signal alone has a strikingly low success rate. Today, why divergence by itself isn't enough, the Confluence filter that separates real exhaustion from random noise, and how to combine divergence with market structure for entries that actually work. Here's the structural problem with divergence. Divergence tells you momentum is fading. The second push was weaker than the first. That's true information, but it's not enough. Momentum can fade for weeks while price keeps grinding higher because momentum and price are different things. By the time the actual reversal arrives, you've been short for a month and stopped out 3 times. The signal that completes divergence is a structural break, a lower high or lower low confirmed after the divergence forms. Without that break, divergence is just an observation, not a trade. Watch this in a synthetic chart. RSI shows bearish divergence at the first high, price up, RSI lower. A trader shorts the divergence, gets stopped out. Divergence persists into a second push, they short again, stopped again. By the time price actually reverses, they've taken 3 losses fighting the trend. The divergence was real exhaustion, but exhaustion doesn't equal immediate reversal. The market needed to confirm the turn structurally before the signal became tradable. Here's the key. A real reversal shows 2 things in sequence. First, the divergence momentum fading while price extends. Second, a structural break, a lower high or lower low that confirms sellers have actually taken control. Without the second piece, divergence is just a warning, not a trade. The break of structure is the market's acknowledgement that the trend has actually flipped. Wait for it, then enter, late by maybe 2%, dramatically safer than fading the divergence directly. Now with the Confluence filter, RSI diverges at the second high, same warning as before. But this time you wait. Price pulls back, attempts another push, and fails to make a new high. Then it breaks below the prior swing low. That's the entry, divergence first, structure break confirms. You enter short on the break, stop above the recent failed high, target the next major support. 2 confirmations, real signal, math-based exit. The same divergence that traps fader traders, used correctly, becomes a high conviction entry. On a real chart, scroll back to any major top and you'll see the pattern. RSI divergence appears 1 or 2 swings before the actual price top. The traders who shorted the first divergence got run over. The traders who waited for price to fail at a new high and break a prior low caught the actual reversal. Same divergence, completely different trade outcome, decided entirely by whether they demanded structural confirmation before committing. So, divergence by itself is a warning, not a signal. It marks fading momentum but doesn't time the reversal. Wait for the structural break, a lower high or lower low that confirms sellers have actually taken control, and then enter. You'll be late by a few % of the move and dramatically safer. The signal that destroys impatient traders becomes high conviction Confluence when you wait for the second confirmation. Subscribe for the full method and trade your own plan. Education, not financial advice.